What's going on, everyone? We're going to talk about option moneyness because I think it's important to talk about. It's something that needs to be at least known before even putting your first trade in for an option, because it's important to know the pricing of the options. So let's talk about this real quick. Option moneyness. What the F is that? You've probably heard of the following terms, so don't worry, it's not too foreign. In the money, at the money, and out of the money. These terms refer to moneyness, which is an important term to understand if you are entering the world of options trading. In this short video, of course, we're going to discuss the basic concepts of option moneyness. And you may know a lot of this already, so keep that in mind. This may be a review. Moneyness refers to how the strike price of the option relates to the current trading price of the underlying assets. So, in other words, moneyness refers to how the strike price of GameStop, or the strike at which you place your bet on, relates to the underlying asset GameStop, as in GameStop's current market price. In other words, moneyness describes the intrinsic value of an option in its current state. And then there's a nice little chart for you right there. So, option moneyness, again, options are classified by traders into three categories based on the relationship of the strike price to the underlying stock price at the current time. The categories describe an option's moneyness. It's important to get a handle on these categories and what they mean before you start trading options, as it's important to know the pricing of the options. Every option strategy will incorporate these terms, and without a solid understanding, beginners can easily find themselves confused. So the three types, again, we have in the money, out of the money, and at the money. Moneyness in single options contracts is a fundamental concept to master when trading options. Moneyness does get more complicated once you start, incorporating some multi-leg option strategies and more sophisticated options as well. Obviously, it would increase in complexity, but from the start, not too hard to understand. So basically speaking, it's important to just get the fundamentals down and take a little bit of time out of your day into learning the difference between these three types. So here's an autistic chart that you probably don't understand. Moving on. In the money. So in the money does not mean that the trader is going to make a profit necessarily, but instead describes the position of the strike price against the stock price at any given time. For example, if you have a call option and your stock price is greater, so if you have a call option for GameStop for $100 and GameStop is at $105, that means you are currently in the money. It's just describing the relationship between the two prices and not the trader's actual profitability. So that's important to understand. If you have a put option, on the contrary, and the stock price is lower than the strike price, then your position is in the money. So you can be in the money on both calls and puts. If you look at your options chain and you see the shaded area, that's going to be in the money. So this is your call side here, your put side here. That may help you, prevent from fat fingering calls by accident when you're trying to buy puts. Remember, the shaded area means in the money, each side respectively. Next, we have out of the money, or OTM. This is the one where most inexperience comes from right here, is out of the money. Out of the money doesn't necessarily mean, again, that the trader has lost money on a trade, but simply is just a generic description of where the strike and stock prices are in relation to each other, again, at the present time, just like in the money. It's all about time, relationship, and where the stock price is. For a call option position to be considered out of the money, the stock price would need to be lower than the strike price, and for a put, the opposite would be true. So if we go back one, oh, it's right. It's the same picture. So you see clearly opposite of each other. Calls in the money. On put side, it's the exact opposite. So your out of the money puts are going to be in the unshaded part, same as your calls. That's the easiest way that I like to look at it. It prevents error. Just look for the shaded area. You're in the money zone, despite which side you're on. So that's the easy way to look at it. So at the money. So options are at the money when the strike price and stock price are at the same level, whether you're trading calls or puts. Describes a price level parity between stock and strike prices, so you could consider this right here at the money. 53 more so, but you could consider both 53 or 54 at the money for the most part. But generically, 53 would be your at the money strike price. Now, determining the value of the option, which is another critical part in options pricing, is based on two major components. You have intrinsic value and you have extrinsic value. So intrinsic value is the value of an option if it expired right now. When traders say an option is in the money, they are saying that it has intrinsic value. Out of the money options has no intrinsic value. When traders say that the contract has expired worthless, it's because an option expired out of the money. The relationship between ITM, OTM, and ATM are all used to help determine the intrinsic value of the option, which is a key factor in options pricing. That's all it's about. Now let's look at extrinsic value. Although extrinsic value plays a less prominent part in moneyness, it is an important concept to understand when trading options. This is going to fall more into the leap category that we're looking into. Extrinsic value has several components. Time value, otherwise known as theta, is the portion of an option's premium that is here we go again. I'm just going to skip that word. To the amount of time remaining until the contract's expiration. Although it's not the only component, time value receives the most attention. You know, theta gang. Time is of the essence. It receives the most attention, which is a critical thing to understand. It's the most that's going to try to be priced into the option. So, as with most things, time is money. I've been telling you all last year, time is money. In this case, time is value. So think of options like that. Time is money, except in the options market, time is value. Typically, the more time that remains until expiration, the higher the extrinsic value of the option. Investors will pay a higher premium for additional time since the contract will have longer to achieve profitability from a favorable move in the underlying asset. So, an ideal situation to get yourself into here is on a beat to hell stock near its all-time low with very, very low implied volatility, which is something we'll cover in a different video, that guarantees almost a very, very good in extrinsic versus intrinsic value parity. Now, the reverse is true when there is less time remaining. For example, if you're playing weeklies, investors are less willing to pay a premium because the stock has less time to become profitable. So it's all about the pricing. That's literally what it's about, man. So how do you incorporate this into your day-to-day trading strategy? Well, when options are in the money, they represent profitable opportunities for traders. For example, buy a call option that is significantly in the money, or buying one significantly in the money presents the same profit opportunity in terms of dollars as purchasing the actual stock, but you can trade with much less capital investment. This can result in a higher return. Selling deep in the money options presents an opportunity to take profit immediately. Plus, there will still be remaining extrinsic value. Remember, the more time, the more value an option contract has. And it's also important to ask this very, very important question. If this option were to expire today, would it have any value? If yes, then the option has intrinsic value. Remember, if no, it has no intrinsic value. This is why in the money is critical, except for in those rare opportunities when profitability is opportunistic out of the money, but it doesn't happen as often, but that's where experience will come in hand. So, in the money is the way. Whee! It was supposed to do something cool. To the moon. Let's go, Brandon. That's not political, it's just funny.